Well, what a great conversation, and to hear what it takes to get to a successful exit. But if you look back over the last nearly 3 years, for a lot of entrepreneurs, a lot of founders, that dream of getting to an IPO or to an exit has in many cases been supplanted by a much nearer term need, which is just raising capital, period. It has not been an easy environment in which startups can go out to raise money. But there is hope, there is capital out there, and there are ways in which, as a founder or a startup, you can go get it. So to figure out how, let's welcome to the stage our moderator, Rhett Power, reporter at Forbes. Rhett, welcome to the stage. In conversation with Sean O'Sullivan, founder of SOSV, prolific venture capitalist, and Jeff Abbott, general partner of Blitzscaling Ventures. Gentlemen, tell us how it's done.
Thank you. So I'm glad you're here at 4 o'clock on is it Tuesday or Monday? What's the day?
It's Monday.
Monday. So I'm glad you're with us. If you need some tea or coffee to get through the next 30 minutes or 20 minutes, please go get some, because we want you to be attentive and paying attention, because these guys are going to really give you some things to take away. My name is Rhett Power. I'm a contributor at Forbes, and I also run a company called Accountability Inc., which is a global executive coaching firm. Guys, we are in a time right now, sort of this inflection point of like running a business, being an entrepreneur, starting a company. And as a founder, funding is always on people's minds. We were talking backstage about what the environment is like right now. Can you guys set the stage or give us a little bit of an idea of what the funding environment is and what you do, what kind of companies you invest in?
Sure. Yeah, I'll take a stab at this. Can people hear me okay? So it's a very different era for getting funding. If you're a startup, even if you're an LP raising funds, from 3 years ago, there was 2,500 deals, venture deals being funded every quarter. And now it's down to 500 deals being funded every quarter. So we've had for the last 2 years and 9 months, for the last 33 months, it's been on this sort of big spike downward and just sideways. Through many different events, like the failure of Silicon Valley Bank that really drove a lot of freezing of the venture capital funding for LPs, as well as, just the interest rate environment, et cetera. But, not only are 80% less deals happening, but there's also, at the later stages, lower valuations in particular at Series B and Series C, where you're seeing 60% less funds being devoted at Series C, but you're seeing 60 to 70% less valuation of the companies at the later stages. So it's a hard time to raise money, because you never want to see a down round, and yet the deals that are getting funded right now at Series B and Series C's are nearly always down rounds. And then Series A's and C's, A's and seed rounds are being funded at a very slow rate, 1 out of 5 deals as compared to a few years ago. And those are the companies that really have a lot of traction or have even profitable, or even break-even companies. So it's a very different market, and we have some words of advice, I think, on how to survive through this market.
Let me ask a real quick question before, Jeff, I give it to you. How many people here are entrepreneurs looking for funding? Can you raise your hands? Yeah. And how many people here are investors? So we've got a majority of people who are entrepreneurs, so that's good. So let's focus on that crowd. Go for Jeff.
Yeah, so as Sean was saying, every year has been a different year. So in our case, we're a relatively new fund. In 2020, we were fundraising, so we were assisted by the pandemic, because initially if you wanted to raise a fund, you would have had to get on an airplane and fly around the world to meet your LPs. But I think everyone benefited a little bit in 2020 from the ability to get on a Zoom call and talk to investors. So that was a little bit easier. 2021 was the area of, raging availability of capital, and a lot of companies were blitzscaling and raising massive rounds and growing without consideration necessarily for unit economics. And then suddenly everything changed. So I know in our own portfolio, companies that were growing very, very fast had to completely reinvent themselves, look in the mirror, take drastic action, and think much more about survival. And if they were able to make it through that period and that big opportunity is still remaining, now they're a completely different company. Smaller, more focused on a core business. And we've had a couple failures during that period as well. In fact, of the companies that seemed the most promising at the beginning. We're now in the middle of raising and deploying an early stage fund. And I think what we've learned is every year is a different year. So certainly the way we're looking at it is we're going to diversify our investments proportionally each year. So each year we call it temporal diversification, but like anticipating that there's a different macro environment and a different set of companies responding to that's going to come every year. Right now we're more focused proportionally on early stage investments, so we're spending a lot more time thinking about the business model, the team itself, the ability of the team to develop a lean model from the start. And yes, we're still looking for the large market with the potential blitzscaler, but the way to get there is not going to just be the massive expenditure of the easily raised money from 2021. So the word blitzscaling to us still means the same in terms of the outcome, but the way we're expecting people to get there today is quite different than it was 3 years ago.
So we have a lot of people in the audience, and let me show another show of hands. Who's trying to raise money right now? Who would like to raise money? Okay. Who's tried and failed? Anybody? Yeah? Okay. So let's again speak to this. What does it take today? You've laid out this sort of dystopian environment. What does it take today to raise money? What are you looking for in the founders? What are you looking for in the product? Maybe the team around the founder?
Yeah.
What do you measure? Like
Well,
when you
I
analyze
think-
somebody, what do you?
I think it also matters. You have to look at each investor separately because some investors are investing at earlier stages.
Right.
Like we invested pre-seed as the first check at inception, of the idea. So we don't expect what somebody at seed or at Series A would be expecting in terms of traction. SOSV has about $1.5 billion in assets under management. We like to invest about $100 million a year. Because of the slowness of follow-on funding, we're only investing right now at about $60 million a year. But for every $100 million a year we deploy, we get about $2 billion in follow-on investment into our companies from later stage investors at Series A, Series B in a normal time. Or even more, $2.5 billion in 2022, I think. So what for the stages where we are the first investor, where we're the lead investor, is at pre-seed. And we're seeing that we can be more selective, that companies need to have a little bit more traction, that scientifically they need to have proven where they are. But the pre-seed valuations haven't really dropped that much at all, and neither have the Series A valuations. It's just that there's 80% less deals being done, so you have to be much more selective. So that's kind of what's happening at our stages. But what success looked like 4 years ago was if you could have 100% growth every year and your next round was an up round. Well, what success looks like today is very, very different because there is no next round. You can't count on having a follow-on round and having that follow-on round be at an up valuation. The market is in free fall and has been in free fall. And so what what VCs, even VCs like us, are looking for is, who are starting very early, is that there's a proven business model that by the end of the seed round, you are going to have enough traction that Series A investors are going to feel really safe investing in your company. By enough traction, maybe it's just $500,000 a year or something like that in revenue, 40, 50,000, maybe $80,000 a month in revenue. But they want you to have that before any Series A investor is even going to think to really look at you. And if you don't have that and you're trying to raise a Series A round, you're going to have a hard time raising. You're going to have a really hard time raising. And Series B rounds are really looking for 5 million or more in revenue. And by Series B rounds, I mean anything like 20 million or more. Series A rounds like 5 to 15 million kind of size. So those are the game has really changed because you're raising a lot less money and you have to show a lot more for it, which means you need to really focus on your revenue, the money coming into the company coming from customers. So rather than coming from VCs. VCs like us should be much more irrelevant to your business than they have been in the last 5 or 10 years, because you have to get all of the money coming into your business from your customers.
And that's not a bad thing.
It's a great thing. My first company I bootstrapped, and that's why I'm on the stage today, is because it went public, with raising $250,000 from my friends and family. 5 years later, 7 years later, it went public, got to hundreds of millions in revenue without needing more than $1 million of VC funding.
So at Blitzscaling Ventures, we're looking for companies that we believe can win large emerging new markets. And the first thing we look for in a company is it blitzscalable? So there's a book from 2018 by Reid Hoffman and Chris Ye. Reid is our anchor investor and advisor to the investment committee. Chris is one of the founding partners. And what we did is take the framework out of the book and we use it to evaluate every business model that we look at. As Sean mentioned, not long ago there were 1,500 deals a month. There were 3 times more deals to look at the growth stage than there are today. Today we're primarily focused on early stage, pre-seed to Series A, in an AI-focused fund. So there's really 3 things that we're looking for in a deal. The first is, does it score over 80 out of 100 on our Blitzscalability Index? Where what we're essentially doing is predicting, do we believe there's this large new category space that this company could grow into? Is this a business model that can scale quickly, faster than the competition, not necessarily at breakneck speed, not necessarily all fueled by VC dollars, but relative to the competition can win this space? And is there something about the business model, whether it's a land grab or lock-in or network effects, that will allow it to hold on and continue to maintain that competitive position? And now that talks a lot about the business model. Now, since we're AI model focused, we're also looking at the use of AI within the team. So first, we have a founder scorecard. We're looking really at the pedigree of the founders. Do you know each other? Have you worked together before? What kind of academic background do you have? Is it strong in the areas that it needs to be strong in? Particularly if it's an AI company, are there strong AI technology chops on the team? Do you have industry background? Have you worked for one of the top companies, maybe, so that you're aware of what they're building and not building into the same space that they're going to consume? What about your character? Are you people, of good repute? Will other people give references for you? We really dig in very deeply. Are you perceived as leaders in the market? Do you have influence? If somebody asked, who is this person that's building this company? Has anybody ever heard of you? Or do you still have some work to do there to sort of be the go-to obvious spokesperson for that new category? So we're digging a lot deeper, I think, in than we did even several years before. And then finally, we're expecting AI to almost be a member of the team. So not only is AI the product or the technology that enables the business model, but how are you thinking about making AI a member of your team, in the sense that your team, the way that you're constructing your functional areas, could be your onboarding process, could be your hiring process, could be any aspect of the business. how are you building AI into that right now? A couple months ago, there was a very illustrative tweet by a well-known venture capitalist called Sarah Guo from Conviction Capital, and she made the statement that it was finally coming true what she had been hearing in the rumor mill, that she had just seen a pitch where the founders had committed to never hiring more than 12 people. That was their threshold. They were going to try to find a way to create a business model that allowed 12 people plus AI to do everything that the company ever needed to do. And then you mentioned, you know, the putative $1 billion company that has a single employee. I don't think we're that exaggerated, but we're not just looking at AI as what's being sold, but as also what's being employed to augment your team so that you can have greater efficiency, longer runway, ultimately more success in any macro environment.
I do want to add one thing, that there really are two different VC markets right now. There's the VC market for generative AI and the prices that are being paid for the and valuations and the traction that's needed, which is really high prices at very low traction. And that's just a matter of hype, and that always happens in markets, you know. So that's happening right now. So if you have an AI model, then it's going to be easier for you to raise capital, because probably half of the money that's being put into venture money is now going into generative AI. But every other sector, even climate tech, where SOSV is the world's leading investor, is down. You know, so and so you're seeing what I was talking about earlier is much more difficult. And even climate tech is down like 50% off of the high of 3 or 4 years ago. So what you have to do for the regular models, and by the way, it's not just, you know, like plenty of companies have AI in them, like Vision AI and things like that. That's not generative AI. Only generative AI is getting that sort of big boost, you know, at the moment. I do think if you are a generative AI company, you have to worry a lot about what the future valuation is going to be like and whether you're going to be able to raise it at the valuation you're raising at now. So if you are raising and you do get a check as a generative AI, count on that maybe being your last check ever, unless you want to have a down round in the future. So that's always the conservative me speaking. We love founders that are bootstrapping. We love founders that take $1 and treat it like it's the dollar they earned working at McDonald's, because, you know, that's how hard you have to make it work for your investors in order to get a good return on that money.
So we've got about a minute and a half left. We're going to do a rapid answer here to this question. Give these guys your best advice for 2025 in like 30 seconds.
I mean, it's the same advice you ever get. Never give up. Finish what you start. Spend your time as the main on the main priorities only, and just work like a dog. I mean, those are the things that are needed to make it in this world, just like it always.
If you're building in AI, which is where we're investing, it makes it possible to do things faster, cheaper, and better than before, but it also makes it possible to do things that are new. And so I would encourage you to think a little bit over the horizon at an imagined future state and build to that, rather than just building like what's under your nose that's incremental progress. I think that has a better chance of success.
I'm just going to keep adding more stuff, right? We can do that, right?
We got 25 seconds. Go.
Okay, so, and just work on the world's biggest and most challenging problems, because those are the things that are going to move the needle anyway. If there's something you know really well, you have to, you know, figure out that you're unsatisfied with the world the way it is, and you know what would make the world a better place. Just work on that major problem, and there are other people that will be drawn to that same problem and want to work at that, even if they're not paid to work at it. They'll join you as co-founders or at underwage or whatever until they make that dream come true.
And thank you. I encourage you to follow these guys. These guys have done it. They've built companies. So follow them on social media. Reach out to them if they're open to it. And thank you for being here today.
Thank you.